If you think investing is only for people with big salaries, trust funds, or finance degrees, this is for you. The truth is simple. Consistency matters more than income size when you are starting, and $100 per week is enough to build real momentum. Most beginners do not fail because they pick the wrong stock on day one. They fail because they never build a repeatable system. They wait for confidence first, they wait for the perfect market first, and they wait until later when they have more money. So this video is a beginner blueprint for real people. No hype, no fake guarantees, no overnight millionaire nonsense. Just a practical way to start investing with $100 per week and keep going long enough to see compounding do its job. Quick disclaimer before we start. This is educational content, not personal financial advice. I am sharing a framework you can adapt to your own goals, risk tolerance, timeline, and tax situation. Here is the first principle. Investing is not step one of money management. Stability is step one. If your financial foundation is unstable, your investing habit will keep getting interrupted by emergency stress and forced withdrawals. Before you invest your first dollar, handle three basics. First, be current on minimum debt payments. Second, build a starter emergency buffer. Third, stop new high-interest debt from leaking into your monthly cash flow. Your starter emergency buffer does not need to be huge to begin. Even $500 to $1,000 can prevent one surprise expense from forcing you to sell investments at the worst possible time or run back to credit cards. Now, once that base is in place, we move to the investing blueprint. Step one is account order. Where you invest can matter as much as what you invest in, especially because taxes quietly reduce long-term returns. If your employer offers a 401k match, start there first. A match is essentially free money tied to your contribution. If you skip match dollars, you are turning down immediate return that is very hard to beat elsewhere. If there is no match, or after you capture the full match, consider a Roth IRA if you qualify. For many beginners, this is a strong next step because future qualified withdrawals can be tax-free, and that matters over decades. If you still have money left after that, or you need flexibility outside retirement accounts, use a taxable brokerage account. It has fewer contribution restrictions, but you need to understand tax implications on dividends and gains. So when people ask, where should my first $100 per week go? A practical order is often employer match first, then Roth IRA, then taxable brokerage. It is not flashy, but it is efficient and beginner-friendly. Step two is automation. Manual investing depends on motivation. Automated investing depends on systems. Systems win because your schedule, mood, and willpower will not always cooperate, but your automation can keep running anyway. Set an automatic transfer of $100 per week from checking to your investment account. Then schedule automatic buys shortly after the transfer lands. Remove as many manual decisions as possible from the monthly process. Weekly investing is powerful for beginners because it reduces timing anxiety. You are not trying to predict the perfect entry. You are buying consistently across different prices, which is the practical behavior behind dollar-cost averaging. Step three is allocation. Beginners often overcomplicate this and freeze. You do not need 12 funds and a macroeconomic thesis. You need a simple, diversified structure you understand and can hold through volatility. A practical beginner setup is broad market index funds, or ETFs. For example, one fund tracking the U.S. total market, or S&P 500, plus optionally one international fund for broader global diversification. If you want extreme simplicity, one globally diversified all-in-one fund can work. If you want slightly more control, a two-fund setup can work. The key is not complexity. The key is broad diversification, low cost, and consistency. Step four is cost control. Fees look small but compound against you over time. High expense ratios and frequent trading costs can quietly eat long-term gains, especially when your starting contributions are modest. As a beginner, focus on low-cost diversified funds and avoid frequent buying and selling. You are building a long-term machine, not running a short-term prediction contest. Lower friction usually means better survival and better outcomes. Step 5 is behavior rules. This is where most people either win quietly or lose loudly. Decide your rules before emotions get involved, because market volatility will test your plan at exactly the wrong moments. Rule 1, do not stop investing just because headlines look scary. Rule 2, do not increase risk because social media says everyone is getting rich fast. Rule 3, do not sell long-term holdings in panic after a red week. Rule 4, increase contributions when income rises. If you start at $100 per week and get a raise, consider moving to $125 or $150. Tiny increases over time create major long-term differences. Rule 5, review quarterly, not daily. Daily checking creates emotional noise. Quarterly review lets you confirm automation, rebalance if needed, and adjust contribution levels without turning investing into a stress loop. Now let us make this concrete with a simple $100 per week blueprint. Week by week, you invest $400 to $500 per month, depending on calendar structure. Over a year, that is roughly $5,200. At first, that may not feel life-changing, but compounding is slow until it is not. The early phase is about building identity and consistency, not showing off account screenshots after 90 days. If you invest $100 per week for 10 years, you contributed about $52,000. If average returns cooperate over long periods, your portfolio can grow meaningfully beyond your contributions through reinvested gains. That does not mean returns are guaranteed or smooth. Some years will be up, some will be down, some will feel flat and frustrating. The point of the blueprint is to survive those cycles without abandoning the process. Let us talk about the biggest beginner mistakes I see. Mistake 1 is trying to optimize everything before starting anything. Perfectionism feels smart, but in money behavior, delayed action is usually more expensive than imperfect action. Mistake 2 is mixing long-term investing with short-term spending goals. If you need that money in 12 to 24 months for rent moves, tuition, or emergencies, that money should not be in volatile assets. Mistake 3 is chasing individual stock tips before building a core portfolio. There is nothing wrong with learning, but your foundation should be diversified first. Speculation without foundation often turns into expensive lessons. Mistake 4 is ignoring taxes and account types. Two people with the same investment returns can end up with different net outcomes depending on account structure, contribution strategy, and tax efficiency decisions. Mistake 5 is quitting after the first market drop. Volatility is not evidence your plan is broken. Volatility is part of the deal. Your edge as a beginner is not prediction. Your edge is disciplined repetition. If you are wondering how to split the $100 each week, keep it simple at first. For many beginners, one low-cost broad market fund is enough to begin. Complexity can come later, after consistency is automatic. If you want a more structured split, you could use a core and support model, such as majority in a U.S. broad market fund and the rest in international exposure. Keep the structure simple enough that you can explain it in one sentence. And if you are currently paying very high interest debt, pause and evaluate honestly. In many cases, attacking high interest debt first gives a stronger guaranteed return than investing aggressively at the same time. Math and stress both matter here. A balanced approach can still work. Capture employer match if available, pay down toxic high interest debt aggressively, build your starter buffer, and then scale the $100 weekly investing habit as debt pressure falls. If your income is inconsistent, use a percentage-based version of this blueprint. Instead of fixed 100 weekly, invest a fixed percent from each paycheck. Same system, different mechanics, better fit for variable cash flow. If you are investing as a couple, alignment matters more than optimization. Agree on contribution amount, account order, and non-negotiable behavior rules together. Shared clarity prevents future conflict when markets are volatile. So what should you do tonight if you are ready to start? Open the right account, set the automatic transfer, choose a simple diversified fund setup, and schedule your first recurring buy. 1 hour of setup can change your next decade. Do not wait to feel fully ready. Most people never feel ready at the beginning. Confidence usually comes after reps, not before reps. Start small, stay consistent, and let the system teach you over time. The brutal truth is that building wealth is usually boring and repetitive, and that is exactly why it works. The beginner who automates $100 every week for years will often beat the person who keeps restarting grand plans. If this helped, comment blueprint, and I will make the next video on a complete beginner investing setup, including account opening checklist, first fund selection framework, and common mistakes to avoid in your first 90 days. Subscribe for practical money systems that hold up in real life, and I will see you in the next one.